Hi, everyone. Welcome to the IBKR podcast studio. I'm your host, Jeff Praissman. It's my pleasure to welcome back to our studio for a monthly podcast, Nasdaq's Michael Normyle. Hi, Mike. How are you?
Doing well, thanks. Thanks for having me back.
Oh, it's always a pleasure. So today I want to dive into, there's been a lot of talk that the U.S. and other developed economies are in a quote unquote Goldilocks zone. Can you explain to our listeners what exactly does that mean?
Sure. So that's how we've been describing the situation that we're seeing in a number of advanced economies where inflation has cooled off and is pretty close to central bank targets. The labor market has also cooled off from extreme levels of tightness, but we've also only seen unemployment rates increase relatively modestly from historic lows. And then lastly, these economies have generally avoided recession in the last year, and many saw solid but not too strong economic growth. So overall, their economies are not too hot, not too cold, and why we call it the Goldilocks. And that's helped their central banks pivot to cutting rates last year and into this year. And this is really especially true of the US, where headline PCE inflation is just above the Fed's 2% target. The unemployment rate is 4%, and the economy saw about 3% real GDP growth last year.
What have been some of the biggest contributors supporting the U.S. economy?
I'd say there are two big factors for the US, and they're the reasons why we avoided recession in 2023 when a lot of people thought that there could be one. And then again last year, and they're government spending and consumer spending. So for the government spending piece, we had big ticket programs come through like the CHIPS Act and the Inflation Reduction Act, which subsidized spending on chips factories and EV battery plants, things like that cost billions and billions of dollars. For consumer spending, it was multiple factors like fixed rate mortgages, partly insulated consumers from the Fed's higher rates, a healthy labor market, plus falling inflation drove real wage gains. So after inflation, there was still a wage growth left over. And then housing and equity asset appreciation increased household wealth. And that creates a bit of a wealth effect where people feel wealthier, so they spend more. And so overall, if we have strong consumer spending in the US, it usually means the economy is doing well since consumer spending alone is about 70% of US GDP.
And obviously, with the new president, especially from a different party, there comes changes. And tariffs has really been in the news lately. And before we get into what impact on inflation they're likely to have, I'd like to drill down on the different countries' share of U.S. imports. The Eurozone, Mexico, China, Canada, Taiwan, South Korea, and Vietnam. Like, how are they all doing?
Yeah, this is something that's actually changed a lot in recent years. And this goes back to President Trump's first term, where he imposed tariffs on China starting in 2018. And compared to the discussions that we've seen at the start of President Trump's those earlier tariffs were more narrowly focused, but they still had a lasting effect on US trade patterns. So looking at the shares of US goods imports, China's share has been essentially cut in half since 2018, falling to about 13% now. So the added cost of importing from China pushed companies to change their suppliers and or supply chains. And with companies changing operations, that included building new factories or staffing new office locations in some cases, we saw beneficiaries from that shift away from China. So China's neighbors like Taiwan, South Korea, and Vietnam, their combined share of US goods imports nearly doubled to 12% now. And we've also seen cases of friendshoring, with the share for the Eurozone, a US ally, rising a bit to 17%, and then also nearshoring with Mexico's share rising to 16%. So the import shares of Eurozone and Mexico are now greater than China's actually.
We really can't talk about imports without discussing trade deficits and surpluses. What are some of the bigger deficits and surpluses the U.S. has with other countries?
Exactly. And this is one of the things President Trump is looking to address with those tariffs. He wants to shrink our trade deficits with some countries. And even after those 2018 tariffs, our biggest trade deficit is still with China, coming in at nearly $350 billion per year. Other major trade deficits are with Mexico at about $100 billion. Japan and Germany are both at nearly $70 billion. And then Vietnam is over 50 billion, and Canada is at about 30 billion. So these countries could be at potentially some greater risk of tariffs to help shrink these deficits.
In 2025, the U.S. having intricate trade relationships with countries all over the world. What impact would increased tariffs have on inflation then?
I think the impact is actually smaller than a lot of people might think for a few reasons. First, as a share of the economy, the US is less reliant on trade than some other major economies. That's total exports as a share of GDP is about 11% in the US. Goods exports are about 7%. So, actually, a pretty small piece of the economy overall. And then, if you look at President Trump's first term, tariffs had pretty little impact on inflation, and the Fed was willing to mostly look past tariffs back then. And then third, as we saw since 2018, companies can adjust supply chains to mitigate the impact of some of those tariffs. So really, it's a subset of products that are impacted. And while it's likely to have some upward pressure on inflation, it's more like going from 2.5% inflation to 3% inflation. But tariffs aren't going to push inflation back to the 9% pace that we saw back in 2022.
And now let's stick with the global theme, but let's not, I don't want to get political. The US is a country of immigrants in which various times in history the numbers have ebbed and flowed. What effect will immigration restriction have on the economy?
So, strictly from a macro perspective, you can think of immigration as a labor supply issue. And we actually saw how restricting labor supply impacted the economy during COVID, though this was a far more extreme example than any immigration restrictions would have, but still it's illustrative. So during COVID, we saw people retire early to avoid getting sick. We saw enhanced unemployment benefits let people hold out for the perfect job. And then travel restrictions led to a drop in visa issuance. When the economy reopened as vaccines rolled out, there was a sudden demand for workers, but there weren't enough workers to go around. At the peak of the recovery, there were 2 job openings per unemployed person compared to 1.2 in 2019. So with this demand for a smaller pool of workers, people willing to switch jobs earned much better pay. And this was called the Great Resignation period at the time. As a result, wage growth increased to 8.5% year over year in 2022 for job switchers. And it also increased for job stayers, but just not as much. As a result, data shows business wage costs have increased 25% from 2020 to today in terms of wage levels. And this became a key factor why we've had this sticky inflation still going on today.
And are there certain sectors that would be more affected than others with immigration restriction?
Yeah, in the case of immigration restrictions, we'll likely see some wage pressures, but they'll be limited to the sectors most reliant on unauthorized immigrants, like construction, agriculture, and hospitality. So that could mean some of those higher wage costs get passed on to the end consumer. But again, this would be far more modest than what we saw during COVID.
Michael, this was a great conversation as always. Are there any final thoughts you'd like to leave the listeners with?
I'd say overall, the US economy is in a good place, and changes from tariffs and immigration restrictions will likely be milder than many people believe in terms of their economic impact. Plus, there are a number of ways that the potentially higher costs can be mitigated. So there's a good chance that 2025, from an economic perspective, looks a lot like 2024 in a lot of ways, though probably with a little bit slower economic growth.
Thanks again to Nasdaq's Michael Normyle for stopping by the Interactive Brokers podcast studio. For our listeners, you can find our podcast on our website under education, click on podcast, or any of the usual outlets such as Amazon Music, Apple, Spotify, and so forth. For now, I'm Jeff Praissman. Thank you for listening.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.